Welcome back to the Deep Dive. Today, we are focusing on a story that uh, doesn't usually make the front page headlines.
Yeah, not at all. It's not about political scandals or celebrity drama.
Exactly. Yet it holds more power over your financial future, your savings, and, your purchasing power than almost any other topic we could cover. This is a story about balance sheets, debt, and global reserve holdings.
We're talking about the very backbone of the global financial system, the US Treasury bond market, and a really fundamental strategic shift taking place within it.
It's a huge shift.
Right.
We've seen a recent, very calculated maneuver by China that has been quietly executing what a lot of analysts are calling the most significant, maybe the most audacious financial strategy of the last few decades.
And what is that?
They have been massively and very deliberately selling off their enormous holdings of U.S. Treasury bonds. Now, if that just sounds like boring financial language, stick with us.
Please do.
Because this is a slow-motion economic transformation. It affects the interest rate you pay on your mortgage, the cost of your groceries, and the future stability of the dollar itself. It is actively changing the geopolitical rules of the financial game.
So our mission today is to go far beyond the headlines and really unpack the structural meaning behind this massive selling spree. We are analyzing the functional and, you could argue, the inevitable decline of what has long been termed the dollar's exorbitant privilege. Our goal is to connect the dots between China's carefully paced strategic financial actions and the profound implications they have for U.S. debt financing, for structural inflation right here at home, and for the very foundation of this emerging, multipolar global economic order.
And when we talk about scale, you really have to grasp the sheer magnitude of this decision. We are talking about China reducing its official holdings by well over $500 billion from its peak.
$500 billion.
$500 billion less financing flowing into the U.S. debt market. That's a reduction that creates immediate and, frankly, very difficult to reverse consequences for everyone holding or relying on U.S. currency. That's the core of our deep dive today.
Let's get into it.
So to truly understand why the calculated sale of $500 billion in U.S. debt by a major world power matters so profoundly, we have to start with a history lesson. Specifically, the year 1971.
Right, the Nixon shock.
The Nixon shock. That was the year President Richard Nixon officially shut the gold window, unilaterally ending the link between the U.S. dollar and gold. And in doing so, he fundamentally reshaped the entire global financial architecture.
Yeah, the one that had been established decades earlier at Bretton Woods. That moment, 1971, is really the structural starting line for the system we have today.
And what was the immediate consequence?
Well, the immediate consequence was that the U.S. dollar became a purely fiat currency backed only by the, quote, full faith and credit of the United States government.
But, and this is the crucial part, the U.S. managed to ensure that the dollar retained its position as the singular most dominant global reserve currency.
And this system, operating entirely without the constraint of gold backing, is structurally unbalanced. It's not a level playing field. It created this monumental, self-perpetuating advantage for the United States.
An advantage that foreign critics, I think it was the French finance minister Valéry Giscard d'Estaing, recognized immediately and famously termed the dollar's exorbitant privilege.
Exorbitant privilege. And that privilege has allowed the U.S. to live a lifestyle that really no other major economy could ever sustain. The core mechanism is deceptively simple, but monumentally powerful.
Which is?
The U.S. prints the dollar, and the world is compelled to accept and hold that dollar as the primary medium of global commerce and value storage.
Okay, let's unpack exactly how that compulsion works. Why does the rest of the world need U.S. dollars just to function?
Well, there are two main drivers of global dollar demand. First is the need for global trade settlement. For decades, the vast majority of international trade, from soybeans to microchips, has been invoiced and settled in dollars.
And crucially, this includes oil, the petrodollar system.
Absolutely, the petrodollar system, which we'll get into. If you are Germany buying oil from Saudi Arabia or China buying copper from Chile, you traditionally needed U.S. dollars to complete that transaction.
So dollars are the essential grease in the gears of global commerce. You can't do business without them.
Exactly. And the second driver is the demand for dollars as a safe asset during a crisis. Historically, when global financial markets panic, when there's a war, a pandemic, a regional banking collapse, where does the money go?
Straight into US Treasury bonds.
Straight into U.S. Treasuries. Global capital flows immediately into what is perceived to be the safest, most liquid asset in existence. And this guarantees perpetual demand for U.S. debt, almost regardless of how fiscally irresponsible the U.S. government might be behaving at the time.
That structural demand sounds like a remarkable safety net. And this is where the analogy really hits home for me.
Yeah, think of it this way, and this analogy really captures the essence of the privilege. Imagine you have a high-tech digital money printer in your basement.
Okay.
All your neighbors, and they represent the global economy, have unanimously agreed that they will accept your printed money as valid payment for everything, for their labor, their goods, their most valuable resources, like oil.
That's already an incredible advantage.
But it gets better. Furthermore, when they get scared, they don't buy their own currency. They buy more of yours and keep it in reserve.
That is the definition of the ultimate structural advantage. It means the U.S., which represents, what, less than 5% of the world's population, can sustain a consumption rate that hovers around 25% of the planet's total resources.
Precisely. And the key financial outcome of this privilege is that the U.S. finances massive, persistent trade deficits year after year, decade after decade. We are importing far, far more than we are exporting.
We're spending more on the global stage than we are earning.
Exactly. No other country could do this without its currency collapsing. The U.S. avoids this fate simply by issuing more debt or printing more currency, which the rest of the world is then compelled to absorb and hold.
So the U.S. is perpetually running a global overdraft, and the rest of the world is basically forced to cover the checks. This is the structural foundation that China is now challenging.
It is. You have to understand that the U.S. trade deficit is China's and other exporters' trade surplus. They accumulate dollars, and they have historically recycled those dollars back into U.S. assets, essentially financing the U.S. consumption that bought their goods in the first place.
So let's frame the shift.
Yeah.
What happens when the largest, most successful neighbor, the one with the biggest surplus, who's been accumulating your printed currency for decades, suddenly turns around and says, you know what, I won't use your printed money anymore?
I found alternatives. I'll use gold or my own national currency, or I'll trade directly with my other neighbors without going through your printed money.
That's the systemic threat we are discussing today. When a nation of China's economic magnitude, a manufacturing behemoth, makes a calculated, visible move away from this cycle, it signals the potential unraveling of the entire post-1971 structural foundation.
And the slow, constant movement of these reserves is, in many ways, far more consequential than a sudden crisis, because it demonstrates a fundamental loss of confidence in the long-term strategic viability of the U.S. dollar as the sole global anchor.
Okay, so let's get into the mechanics of this, as you called it, unsustainable lifestyle.
Mm-hmm.
Every individual, every family eventually hits a ceiling when they spend more than they earn. You run out of credit.
Mm-hmm.
But the U.S. federal government has run annual budget deficits for over 40 consecutive years. That level of persistent overspending requires constant, just staggering amounts of new borrowing.
And as we established, that habit has been financed by global central banks. Countries that earn large trade surpluses with the U.S., particularly in Asia, had all these dollars and, needing a safe place to store them, recycled them back by purchasing U.S. Treasury bonds.
They financed the very consumption that created their trade surplus in the first place. It was a closed loop.
It was a perfect self-reinforcing cycle for the U.S., and for over 2 decades, China was the undisputed heavyweight champion of this cycle. They were the largest foreign financier of the U.S. federal debt.
Right. And the scale of China's position is just crucial to grasp here.
It's everything. At their peak holding around, say, 2013, 2014, China held over $1.3 trillion in U.S. Treasury securities. It's a number that's so big it almost requires context to understand the strategic implication.
1.3 trillion. I mean, that's almost meaningless without a comparison point.
Let's put it this way, that single holding China's reserve of U.S. paper debt was greater than the entire annual gross domestic product of major, complex, industrialized nations like Mexico or Indonesia or Spain.
Wow.
They held more in U.S. debt than entire countries produce in a year. When you hold that much debt of your rival, you become a critical strategic player in their stability, whether you intend to or not.
So the irony here is just incredibly thick. China was lending the U.S. colossal amounts of money.
Mm-hmm.
And the U.S. was using those funds, often borrowed at very low interest rates, to finance its own strategic and domestic priorities. Everything from huge military operations in Iraq and Afghanistan to tax cuts that increased domestic deficits and even corporate bailouts during the financial crisis.
The situation created a fundamental geopolitical paradox. China was simultaneously engaged in economic competition with the U.S. while also funding the U.S.'s capacity for global military and political projection. This tension defined the relationship for years.
Which brings up the crucial strategic calculation. Why did Beijing voluntarily play along with this dangerous arrangement for so long? The standard explanation you always hear, that it was mutually beneficial, cheap financing for us, market access for them, that doesn't really explain why they allowed themselves to be so exposed.
No, it masks the reality that they were for a long time in a kind of strategic checkmate.
Yep.
Well, the critical factor wasn't a desire to fund the U.S., it was a severe lack of viable alternatives. When China's export engine was generating literally trillions of dollars, those dollars had to be invested somewhere safe and liquid.
And there was only one game in town.
For decades, US Treasury bonds were considered the only market deep enough, liquid enough, and stable enough to absorb the massive scale of capital flows China was generating. Trying to move that kind of money into any other currency or asset class would have instantly crashed those smaller markets.
So they were trapped by the sheer success of their own trade model.
Absolutely. But this necessity created an enormous hidden financial and political vulnerability for China. By holding so much U.S. debt, they were exposed to the ultimate financial power of Washington. They faced two huge intertwined risks that were always looming in the background.
Let's dig into those risks. The first is the most overt and the most dangerous: the risk of political weaponization.
Yes, the risk of asset freezing. The fear that if geopolitical relations deteriorated, say, over Taiwan or a major trade dispute, Washington could, with an executive order under emergency powers, freeze those assets.
Which would mean that over $1 trillion of China's carefully accumulated national wealth could be instantly rendered unusable, just stuck in the U.S. financial system. That's financial coercion at the highest level.
It is. And when we say freezing assets, what does that practically entail? It typically begins as a temporary lock, a prohibition on the transfer, sale, or access to those assets.
But for a country that needs liquidity and access to that capital, it functions exactly like a seizure.
Precisely. It means the assets cannot be used to stabilize their own economy, fund their military, or settle their international payments. It's an immediate, massive loss of financial sovereignty.
And the second risk, the one that, well, you're all paying for right now, is the risk of devaluation.
The more insidious risk, exactly. The risk that if the U.S. decides to address its own deficits by massive new dollar issuance, unprecedented levels of money printing or quantitative easing, the real value, the purchasing power of China's $1.3 trillion in holdings would decrease dramatically.
So China would effectively be paying a massive hidden tax to cover U.S. fiscal mismanagement and inflation.
That's a great way to put it.
But hold on a second. If China is strategically selling down its treasuries, as we know they are, doesn't that immediate selling action inherently depress the value of the remaining bonds they hold? I mean, are they sort of shooting themselves in the foot for a geopolitical win?
That's an excellent challenge, and it really hits on the core trade-off here. And the answer is yes, absolutely. Any large-scale selling effort, even a gradual one, puts downward pressure on bond prices. That means China accepts a lower price for the bonds they sell and incurs losses on the remaining holdings. But this highlights the severity of the strategic calculus in Beijing.
They've done the math.
They view the short-term financial loss from selling, even if it's in the tens of billions of dollars, as a necessary controlled cost, a cost to eliminate the far greater existential risk of future weaponization and freezing of the entire, 800 billion plus portfolio. It's like paying a massive insurance premium to secure your financial sovereignty.
So the goal isn't profit maximization. The goal is strategic risk mitigation.
Exactly. They are sacrificing liquidity and some short-term value to achieve long-term strategic independence from the dollar system.
This inherent weakness, this risk of freezing, it was theoretical for decades. It was a what-if scenario. But then came 2022, and theory became a brutal, undeniable reality. China, along with every major financial power, watched closely as the U.S. and its allies responded to the conflict in Ukraine. And that observation, you could argue, changed Beijing's long-term financial strategy overnight.
That turning point was the swift, decisive action taken by the U.S. and European powers against the Russian central bank. The critical defining data point here is the freezing of approximately $300 billion of Russian central bank reserves.
$300 billion. The world watched a G20 country's sovereign wealth, accumulated over years of trade, become instantly inaccessible due to the political will of a few Western nations.
It was more than just an economic sanction. It was a definitional moment, as you say. It was a live demonstration of the absolute weaponization of the dollar system.
Right.
And crucially, Russia's reserves were massive, well over 600 billion. The fact that only 300 billion were frozen highlights where the vulnerability lies. It was the reserves held in dollars, euros, and other allied currencies, primarily located in Western financial institutions.
The reserves held in gold or within Russian borders were untouched.
Untouched. This showed global financial strategists that dollar-based assets were not just reserve assets, they were, in fact, hostages.
That immediately put every nation with geopolitical disagreements with Washington on high alert, but most notably, China.
Absolutely. Let's try to put ourselves in the shoes of the strategists in Beijing. They look at the global landscape and their massive financial exposure. They still hold a staggering amount of US Treasuries, even after some initial selling, still well over $800 billion at the time of our sources.
And this is all happening against a backdrop of escalating, very visible geopolitical tension. The U.S. government and its security apparatus views China not just as a competitor, but explicitly as the primary strategic rival.
Correct. We see the official Pentagon designation. We see the active building of military containment alliances in Asia like AUKUS and the Quad. We see targeted trade tariffs, severe restrictions on key technological inputs like advanced semiconductors.
And we hear constant high-stakes discussions about the potential military defense of Taiwan.
So on one side, you have explicit military and trade containment efforts by your primary rival. And on the other, you have hundreds of billions of your national savings sitting in assets that same rival has just demonstrated it can freeze with the stroke of a pen.
The logical conclusion for Beijing was immediate and overwhelming. This is a strategic trap.
It had to be. The policy response had to be to accelerate the reduction of exposure, diversify rapidly into alternative assets, and build parallel financial infrastructure that could withstand sanctions. If you know your assets can be weaponized against you, holding them becomes an unacceptable national security risk.
And the data from the U.S. Treasury Department confirms this isn't just a random market fluctuation. It's a deliberate, multi-year strategic execution.
The trend is unmistakable. We can trace the holdings from that peak of over $1.3 trillion down to the current figures, which are below $800 billion. It's a continuous, persistent reduction of more than $500 billion.
And that $500 billion loss of financing for the U.S. deficit is the quiet structural earthquake that is transforming U.S. fiscal stability.
And the method matters as much as the scale. Why this slow, gradual selling, this strategic retreat instead of a massive, punitive dump? Wouldn't a sudden dump cause more chaos and hurt the U.S. faster?
That's a good question.
It would cause massive, instant chaos, yes. But crucially, that chaos would be incredibly costly to China itself. If China dumped all $800 billion on the open market tomorrow, bond prices would crash, interest rates would spike globally, and China would incur massive instant losses on the sale of its own reserves. I mean, potentially destroying $50 billion or more of value overnight.
So they're accepting controlled, limited short-term losses to avoid a much greater strategic and financial catastrophe later.
Exactly. It's the difference between an orderly, planned evacuation where you minimize damage and panic versus running out of a burning building where everyone tramples each other.
Right.
China's measured approach, selling consistently through intermediaries over years, allows them to achieve their strategic goal de-risking their reserves while simultaneously avoiding self-inflicted financial wounds and maintaining a veneer of market stability. This demonstrates deep calculation and strategic patience.
And what makes this really concerning for the U.S. is that China is not isolated in this move. This strategic retreat is proving to be contagious across the global financial landscape.
It absolutely is. Central banks are rational actors. They see the precedent set by Russia. So we are seeing simultaneous reassessments of dollar-based asset risk globally.
It's not just China.
Not at all. Japan, historically a massive buyer, is reducing its positions, albeit slowly. Russia, post-2022, has liquidated almost all of its remaining dollar holdings. India is accumulating physical gold at unprecedented rates, consistently ranking among the top buyers every single quarter. Brazil and many South American nations are actively moving forward with bilateral local currency trade agreements.
And then there's Saudi Arabia, the traditional linchpin of the petrodollar system.
Correct. Saudi Arabia is the ultimate domino in this game. They are diversifying their reserves away from dollars and, most significantly, entertaining or actively pursuing the sale of oil in currencies other than the dollar, particularly the Chinese yuan.
Every one of these actions, Japan reducing, India buying gold, Saudi Arabia pivoting, is a small hole in the ship.
And the collective effect is a systemic weakening of the dollar's central role. You have to note the historical data. The dollar's share of global reserves has already dropped from over 70% 2 decades ago to around 58% today. This is not a theoretical threat. This is demonstrable structural movement.
Okay, so for decades, whenever the dollar's dominance was questioned, the immediate retort from U.S. economists was always the same. There is no alternative.
Tina, right. There is no alternative.
Exactly. The dollar's too big, too deep, too liquid. Any talk of de-dollarization is fringe theory. But the source material and the actions of China suggest that premise is now fundamentally outdated.
That old defense was built on a kind of complacency, an expectation that rivals couldn't coordinate or innovate fast enough. China realized that if they wanted to escape this financial checkmate, this strategic trap of having their reserves weaponized, they couldn't wait for another country to invent a solution.
They had to engineer the alternative infrastructure themselves.
Precisely. And they have done so systematically, constructing what we might call the de-dollarization toolkit.
What does that systematic alternative infrastructure look like on the ground? Let's talk about the global financial plumbing.
Well, the first critical piece is bypassing the Western-controlled payment infrastructure. China created CIPS, the Cross-Border Interbank Payment System.
CIPS?
This is functionally China's answer to SWIFT, the Society for Worldwide Interbank Financial Telecommunication, which writes the vast majority of global payments and is ultimately susceptible to U.S. European control and sanctions.
So CIPS is the technological off-ramp. How does it stack up against SWIFT in terms of real-world functionality and volume?
Well, CIPS is currently much smaller, but it's growing rapidly. SWIFT handles tens of millions of messages daily, connecting over 11,000 financial institutions worldwide. It's the dominant player.
Right.
CIPS, by contrast, is primarily focused on facilitating yuan-denominated payments. And while its transaction volume is still a fraction of SWIFT's, it is specifically designed to allow transactions, especially those involving countries under U.S. sanctions, to occur without touching the U.S. financial system or relying on U.S. correspondent banks.
So it offers financial sovereignty, even if it sacrifices some liquidity for now.
Exactly. With CIPS, China controls its own infrastructure and can move money internationally, bypassing that choke point in Washington.
And the second part of their strategy?
The proactive promotion of the yuan itself. This involves establishing bilateral currency exchange agreements, known as swap lines, with dozens of nations. These agreements allow countries like Brazil or Russia to bypass the dollar entirely when trading with China, settling trade directly in yuan or their local currency.
They're also setting up clearing centers.
Aggressively. They're establishing yuan clearing centers in major financial hubs globally, from London to Singapore to Frankfurt, making the currency easier and more efficient to use in international commerce.
But the most tangible, oldest, and least sanctionable asset they are accumulating seems to be gold. The oldest money in the world.
Gold is the ultimate strategic hedge against fiat currency risk and financial coercion. China has been one of the world's largest gold producers and, simultaneously, one of the largest buyers globally for years.
But their official holdings don't always reflect that, do they?
No, the People's Bank of China, the PBOC, keeps its exact holding figures quite secretive. But all reliable estimates suggest they have accumulated thousands of tons, often bought through state-owned commercial banks, to mask the strategic intent.
So why gold? We've seen the risks of holding U.S. debt. What is gold's inherent appeal in this new weaponized financial environment?
Gold possesses crucial properties that sovereign bonds, especially U.S. bonds, lack. First, gold cannot be sanctioned or frozen by any executive order. Its value is tangible and physical.
And second,
it cannot be created at will by any central bank through a printing press or a digital ledger. It is real, tangible wealth. You could call it financial sovereignty insurance. If tomorrow the U.S. froze all of China's dollar assets, that gold, held securely in Beijing or elsewhere, would retain its value regardless of U.S. political policy. It is the ultimate de-risking tool.
that makes profound strategic sense for a nation that views its primary rival as potentially hostile. Now, let's talk about the political structure supporting this shift. The BRICS bloc, which is now expanding.
Yes, the growing political and economic cohesion of BRICS Brazil, Russia, India, China, South Africa, and now several others is undeniable. This group now collectively represents a larger share of global GDP than the established G7 nations.
This is no longer just a political forum.
Not at all. It's an emerging economic counterweight that is actively seeking alternatives to Western-led institutions. And they are building parallel institutions, not just talking about them. They're discussing a shared trade settlement currency to facilitate commerce among members, and they've established the New Development Bank, or NDB.
Which is designed to compete directly with institutions like the World Bank and the IMF.
Exactly, providing financing for developing world infrastructure without the often politically charged conditionalities tied to Western loans.
But we should be fair here. An informed audience needs to acknowledge the challenges of a BRICS currency. It sounds great on paper, but managing trade between five diverse, sometimes rivalrous economies like China and India is incredibly complex. What are the major hurdles?
That's a crucial point to make. For the BRICS currency idea to work, they face massive technical and political hurdles. First, you have capital controls. China strictly controls the movement of the yuan across its borders.
Right.
If you use the yuan for trade, how easily can the recipient country repatriate those funds or invest them globally? This lack of free convertibility severely limits the yuan's appeal.
And the second hurdle is trust.
It's all about trust. Countries like India and Brazil might be happy to avoid the dollar, but they are also deeply wary of adopting a system that would put them equally under the financial influence of Beijing. A truly shared currency, like the euro, requires deep political and fiscal integration, which is currently non-existent among these nations.
So the immediate threat isn't a unified BRICS currency replacing the dollar overnight.
No, but the collective bilateral agreements are undermining the petrodollar. This is where Saudi Arabia comes back into focus.
Right.
The petrodollar system, established in the 1970s, ensured that the world's most critical commodity oil was priced and sold exclusively in dollars. This created guaranteed, massive, permanent global demand for the dollar.
A closed loop.
Exactly. Now, with Saudi Arabia potentially integrating with the BRICS framework and actively discussing selling oil in yuan, that core pillar is under direct existential threat. If the world's major oil producers start accepting non-dollar currencies, the automatic global demand for dollars naturally and consistently decreases.
It's the sheer collective momentum of these bilateral trading trends that really shows the erosion. It's not one big collapse, but 1,000 small leaks in the system.
Precisely. Argentina and Brazil trading in local currencies, India and Russia in rupees and rubles, China and Saudi Arabia discussing yuan trade. Every one of these bilateral agreements, even if small in isolation, is a strategic choice by a sovereign nation prioritizing financial sovereignty over dollar convenience. And this slow, steady erosion, fueled by China's strategic actions, is making the U.S. problem of debt financing much, much harder.
Okay, we must now pivot from this geopolitical chess game to the immediate, tangible realities facing the U.S. economy and, most importantly, your household budget. The critical problem for the U.S. is the convergence of massive deficits and waning foreign demand. You called it impossible math.
It is impossible math. The U.S. has a multi-trillion-dollar spending habit every year. That is, for all intents and purposes, politically non-negotiable. These deficits require constant, aggressive borrowing just to keep the government functioning.
And the debt cycle trap is now tightening violently. We've hit a point where the interest payments alone on the existing national debt now exceed $600 billion annually.
And that figure is set to climb rapidly with higher interest rates.
Let's put that $600 billion into context for you. That's an almost unimaginable sum of money just to service past debts.
It's a huge opportunity cost. $600 billion is more than the annual budget of entire federal departments. That money could fund NASA for 3 years. It could pay for universal pre-kindergarten for every child in the country, or completely rebuild the infrastructure of 3 major U.S. cities from the ground up.
Instead, it is spent simply keeping up with interest payments.
The U.S. is now forced to borrow more every single year just to pay the interest on the money it already owes. It's a self-feeding, accelerating spiral.
And this spiral is accelerating precisely when the traditional foreign buyers, China, the Gulf states, even allies like Japan, are strategically reducing their purchases.
Right.
So if foreign demand is waning, who exactly buys the enormous volume of bonds necessary to fund this year's multi-trillion-dollar deficit?
This is where the structural vulnerability becomes acute. With foreign demand diminishing, the primary buyer of last resort increasingly becomes the Federal Reserve itself.
The Fed. And when the Fed starts buying up massive amounts of government debt because the private market or foreign central banks won't, we enter politically sensitive and economically dangerous territory.
The technical term is the monetization of debt. This is where the central bank uses its ability to create money out of thin air digitally to purchase the government's debt obligations.
It is functionally printing money to finance the government spending deficit.
It is. It bypasses the natural market discipline that would otherwise force the government to cut spending or raise taxes.
So walk us through the mechanics. How does this monetization work, and why is it fundamentally different from a commercial bank buying the debt?
Well, when a foreign central bank buys a bond, they are using dollars they earned through trade. They're recycling existing currency. But when the Federal Reserve buys a Treasury bond, it executes what's called an open market operation. It credits the seller's bank account with brand new dollars that did not previously exist.
So it's new money entering the system.
It increases the Fed's balance sheet and injects massive fresh liquidity into the financial system. This action is distinct because it directly funds government spending by expanding the money supply without any corresponding increase in goods or services.
We saw this playbook executed dramatically during the 2008 financial crisis, and again, far more aggressively during the pandemic. Give us the scale of the recent monetization effort.
The scale was truly unprecedented. From late 2019 to its peak in 2022, the Federal Reserve aggressively expanded its balance sheet from less than $4 trillion to over $9 trillion.
So that's $5 trillion created from nothing.
Approximately $5 trillion created from nothing in a very short span of time, specifically to absorb government debt and stimulate the economy through liquidity.
And the direct, unavoidable, non-abstract result of that massive, sudden influx of new money into the system.
The highest sustained inflation the U.S. has seen in 40 years. This is the direct, painful link to your daily economic struggle. When you dramatically increase the supply of money without increasing the supply of goods, the value of every existing dollar falls.
Let's connect that monetization directly to real-world price increases that people are feeling today.
We saw immediate, sharp increases across essential goods. Food prices increased dramatically, often between 20 and 40% across staple items.
Yeah.
Housing and rent costs surged, driven by massive liquidity flowing into real estate markets. Gas prices, driven by the global dollar dynamic, also skyrocketed. All this liquidity eroded the value of existing dollars and savings, reversing decades of relative price stability.
And this money creation is not a neutral act. It creates a massive social consequence because it does not affect everyone equally.
This is the key social failure of debt monetization. The people who get hardest are those living on fixed salaries, pensions, and hourly wages, the average working and middle class.
Their dollars immediately buy less.
Exactly. It's a severe, forced drop in their real wages and living standards. Meanwhile, owners of hard asset stocks, housing, private equity benefited immensely as the massive liquidity created by the Fed pushed those asset prices higher. It creates a K-shaped recovery. Asset owners get richer, while wage earners suffer structural poverty erosion.
So the core trap the U.S. now faces is an impossible political choice, made far more difficult by the loss of China and others as reliable financiers.
There are only two realistic paths forward to fill the multi-trillion-dollar hole, and both are politically poisonous. First, implement politically impossible dramatic spending cuts, which would require shutting down entire federal departments or dismantling popular entitlement programs.
Never going to happen.
And second, continue the path of monetization of debt, where the Fed buys the bonds that foreign buyers reject. This leads to sustained structural inflation and a persistent decline in the domestic standard of living. The loss of foreign financing removes the safety valve, leaving the U.S. facing these two agonizing choices.
It is essential to recognize that the dollar system has been more than just an economic convenience. It has been the bedrock of U.S. global influence for over 50 years. The exorbitant privilege is what financed America's unparalleled global projection of power.
That structural financial advantage is what has enabled the U.S. to maintain hundreds of overseas military bases, effortlessly impose debilitating financial sanctions on rivals, and support a defense budget that is significantly larger than the next 10 countries combined.
Everything we understand about U.S. global dominance, the ability to act unilaterally, rests fundamentally on the world's need and demand for the dollar.
And here is the unavoidable consequence. If the dollar's special, singular position weakens, if countries are no longer compelled to use and hold the dollar, the entire financial and military structure of U.S. influence begins to shake. The capacity to command rather than negotiate is diminished. Sanctions become less effective over time.
Now, we do have to acknowledge the counterpoints. China has profound structural problems of its own, a debt crisis in its real estate market, a rapidly aging population, slowing long-term growth. Why are we so focused on China's strategic move rather than its deep weaknesses?
Because the discussion is not about whether the yuan will instantly or perfectly replace the dollar. That is a distraction.
It's about something else.
The core strategic reality is about optionality. For the first time in 50 years, the world has viable structured alternatives, CIPS, gold, bilateral swap lines, BRICS institutions that countries can and are actively using to manage their own risks and increase their financial sovereignty. China's action is just the largest, loudest signal that the era of forced reliance on the dollar is over. They are leading the exodus.
So, given this erosion, what are the limited and inherently risky paths forward for the United States? The ability to simply print our way out of it is now constrained by the risk of hyperinflation.
Well, we can outline 4 potential interconnected outcomes. All of them are fraught with difficulty and require a reckoning with this new multipolar reality. First is strategic acceptance.
What does that look like?
The U.S. could accept a multipolar world where the dollar remains important, maybe alongside the euro and the yuan, but is no longer the sole dominant reserve currency. This would necessitate profound humility and, more critically, an immediate return to fiscal responsibility, which seems politically unlikely.
Okay, what's the second path?
The second is the highly dangerous path of coercion. This involves the U.S. attempting to force the world to continue using the dollar, likely via more financial sanctions, trade pressure, or possibly direct actions to control strategic global commodity flows.
That sounds incredibly risky.
It's extremely dangerous because it escalates an economic transition into a direct geopolitical confrontation, risking open conflict as countries fight for financial independence.
Third is simply maintaining the status quo, kicking the can down the road.
Which leads inevitably to the fiscal crisis scenario. If the U.S. continues its current path, massive deficits, heavy monetization of debt to fill the gap left by China's retreat, it risks an eventual hard-landing fiscal crisis.
Which means?
A loss of market confidence in the US Treasury bond, skyrocketing interest rates, and deep, painful cuts to popular public programs. A reevaluation of US financial stability enforced by crisis, not by policy.
And the final outcome, perhaps the most likely in the medium term,
is gradual fragmentation. The global system slowly splits into distinct competing currency and trade blocs, a dollar bloc with North America, Western Europe, some allies, and the yuan bloc with China, Russia, and potentially significant parts of the developing world.
And trade between those blocks would become much harder.
Exponentially more complex, expensive, and riskier. So there is no single dramatic collapse, just a constant, slow, frictional erosion of the old single global order into 2 or more spheres of financial influence.
China's massive bond sales were a calculated, highly visible signal that they are no longer strategically trapped in the dollar system. And that signal, crucially, creates a powerful negative feedback cycle.
It creates a self-fulfilling prophecy that accelerates the decline. When major countries see that a power like China can successfully reduce its bond exposure and build alternatives, they gain confidence to do the same.
So more countries sell bonds.
Which pushes the market interest rate up, making it exponentially more expensive for the U.S. to finance its soaring debt. That high cost necessitates more money creation by the Fed, which drives more structural inflation, which further reduces global confidence in the dollar, leading to even more selling. It's a fiscal spiral that feeds on itself, and China provided the initial push.
So what does this massive abstract financial maneuver? China selling hundreds of billions in treasuries and building parallel financial infrastructure mean for you, the listener, right here, right now? It means the world you grew up in, the one where the U.S. financial system was the undisputed anchor that absorbed all global shock, is structurally fading.
If the dollar's special privilege weakens, the structural ability of the U.S. to run perpetual trade deficits decreases. Imports, which make up nearly every consumer good we use, will become structurally more expensive over time, driving up prices across the board.
And there's another cost.
A big one. If the U.S. government has to pay dramatically higher interest rates on its debt, that money is diverted directly from domestic investments in education, infrastructure, scientific research, and essential public services, leading to a long-term decline in the quality of public life.
This is not just theory. This affects your ability to pay rent, your cost of groceries, and the long-term stability of your retirement savings.
Economists who have pointed out these structural contradictions, that a reserve currency nation cannot perpetually run massive deficits without consequence, have warned about this for decades. The U.S. government ignored those warnings because the privilege allowed it to.
For a time.
For a time. China selling bonds is not the final chapter, but it is the definitive beginning of a fundamental and likely irreversible transformation of the global economic order. You need to be prepared for the consequences of this emergence of a new financial reality.
We often focus on the dramatic, sudden collapse, the moment of catastrophe. But the most dangerous scenario for the average person might just be the slow, boring, yet constant erosion of purchasing power caused by the gradual fragmentation of the global financial system. So we ask you to consider, how will you reposition your own financial and career planning if the world truly divides into competing dollar and yuan currency blocks? And what non-sanctionable assets will you prioritize in a system that increasingly values national and personal financial sovereignty over the pure, simple liquidity the dollar once offered?